Well, the S&P 500 gained more than 12% last year, and if my next guest is right, the stock rally shows no sign of topping off. Christopher Verrone is head of technical analysis at Strategas Research Partners. He was formerly with the economics team at ISI Group and at the Foreign Policy Institute. So, Chris, you're pretty bullish.
I am.
And we're not really talking, this is not about fundamental analysis so much as it is looking at the charts and the trends. And a lot of people, I think technical analysis is something you really have to sit down and study to understand it. So I know you brought a chart in today, and the first chart, I guess, is a chart of the S&P cumulative advanced decline line. Now, first, why don't you just explain the chart, what it is, and it seems to be bullish only because it's going up.
Sure.
In simple terms.
The advanced decline line, we look at it as a measure of breadth, as a measure of participation in the market. So what we like to see is breadth and price always in confirmation. So with the rally that we're in the middle of right now, we've seen the market essentially go up uninterrupted since September, October, but we've also seen breadth continue to make new highs. It's very rare for the market to be articulating a top when breadth is also making new highs. So we like the fact that as we've gone higher, participation has expanded into the rally instead of contracting. And
when you say participation, meaning across sectors?
Exactly. We're seeing large caps perform, we're seeing small caps perform, and even if we look at something like the small cap, large cap ratio, that's at a 25-year high. So we're seeing the signs of participation and breadth that keep us very constructive on 2011. And what we're telling clients is that ultimately 2011 might end up looking a lot like the characteristics that we saw play out in 2010. And by that I mean, what was so compelling about 2010 was pretty much at every major technical level, as we sold off at certain points, buyers stepped in to support this market. And in our view, that's a testament to the internal picture, how strong that technical backdrop is right now.
So what is your forecast? Do you think S&P up another 12%
Sure.
for the year?
We're basically telling clients that we wouldn't be surprised to see the S&P have a 1400 handle on it, maybe 1450. And one of the key tenets behind that call is we're so impressed with the market leadership backdrop right here. We're seeing very cyclical groups that are cyclically tied to the economy break out to multi-year highs, break out to multi-decade highs. That's a very compelling backdrop to be owners of stocks.
Okay, any particular sectors, though, that you think could actually sort of throw a monkey wrench in your thesis?
Well, one thing that we're saying right now, an area to probably be cautious over the next couple of weeks, is probably with some of these retail stocks. We're telling clients that areas of the market that have gone uncorrected over the last couple of months probably look a little toppy here, and retail in particular. We look at the XRT, which is the retail ETF, and we're seeing some signs that momentum might be waning there. So we'd be a little cautious over the next couple of weeks with some of those retail names.
Okay, let's talk about a different market overall that I think also supports your thesis. Commodities have been on a tear. There are real global macroeconomic issues driving some of the pricing. And the other side of it is, real flight to safety. A lot of people seeing gold rising to new highs, and that's over fear of what is happening economically. But you focus on copper, so tell me something about the trends in copper.
Well, why copper is so compelling to us right now is it's been an excellent leading indicator over the last couple of years. And if we just rewind back to early 2009, when the S&P was making its bottom in March 2009, well, copper bottomed 4 or 5 months before that in late 2008. So we began to see a signal in late 2008 that the cyclical backdrop was probably changing, probably improving. And if we again think back to July of this past year, when the market sold off to 1010. Again, it was copper that started to go up first, about a month before that. So we like to see copper as a leading indicator. So we're encouraged that this week copper's hit a new 5 or 6 year high. That tells us that we want to be owners of stocks that are exposed to that trade. So it's the material names.
What would have to happen for your forecast to change?
Sure.
So tomorrow we have an important economic indicator coming out, the monthly employment report. If all of a sudden, for some reason, we see unemployment tick up to 10.2%, which may seem outrageous, but let's say that actually happens, would that change your thesis? Do you look at specific economic indicators?
Sure. As technicians, we like to look at what the charts are telling us. So when I see economically sensitive names, like IBM at an all-time high, or Caterpillar making all-time highs, Freeport making all-time highs. These are very cyclical stocks. The railroads continue to break out. We have a tough time looking at one poor economic report as changing this base case for us. The cyclical backdrop of the market right here, we think is probably too strong to fade. And the only thing I would say is we're probably very overbought here with the broader market, but we would use any near-term sell-off as an opportunity to accumulate as we push down the road in 2011.
So very bullish. Let's talk about the banks. Financials, not all financials participated in last year's rally.
Sure. I think what makes the 2011 bull call easier to make today than, say, a couple months ago is that we're beginning to see the banks participate in this move. And at roughly 15% of the weight of the index, when the financials are working, it makes the bull call a lot easier to make. And we're seeing the KBE, which is the banking ETF, at 8-month highs. We're seeing stocks like Citigroup at 8-month highs. Bank of America closed above its 200-day average yesterday for the first time in 7 or 8 months. So we begin to get more comfortable with the leadership profile when the banks are participating.
All right, Chris, thank you so much. Christopher Verrone live in our studio today. He's head of technical analysis at Strategas Research Partners. All right.